There are moments in the financial markets when everything feels inevitable, when the charts look bulletproof, when optimism drowns out caution, and when fortunes seem only one rally away. But history has a habit of whispering warnings long before the crowd hears them. And if you look closely enough, you'll notice that the people who truly understand the rhythm of the market rarely speak in headlines, they speak through their actions. What you're about to hear is not fear-mongering, not clickbait, and not a prediction of doom. It is a pattern, one that has repeated across every major bubble of the modern era. And today that pattern is flashing bright red. Imagine it's November 2025. Nvidia is breaking yet another all-time high. Your portfolio is green for the first time in months. Everywhere you look, analysts are cheering the unstoppable rise of artificial intelligence. It feels like the future is arriving all at once. Then you read something that turns your excitement into a knot in your stomach. Stanley Druckenmiller, the investor who transformed $12 million into $12 billion, the same man who publicly identified the AI explosion back in 2023, just filed his quarterly 13F. You scroll down expecting to see a mountain of Nvidia shares. But instead you see a number that freezes you. 0. Not a trim. Not a partial rebalance. A full exit. While retail investors were celebrating new highs, he was walking quietly to the door. And here's the part most people don't understand. By the time you read about his sale, the move is already finished. He is in cash. He is repositioned. Meanwhile, your buying became the liquidity he needed to leave the trade. And this time, it isn't just a billionaire locking in profits. It's a signal, a bell ringing at the very top of a euphoric cycle. Financial media will give you the comfortable narrative. He's just rebalancing. He's trimming a big winner. This is normal after such a run. But anyone who has followed Druckenmiller's career knows he doesn't operate that way. This is the same investor who held Amazon throughout the 1990s, who stayed with Facebook during its hypergrowth years. When Druckenmiller believes a technological shift is real, he stays until the fundamental story changes. He doesn't sell because something went up, he sells because something underneath the surface is breaking. To understand what he's really doing, look at the context. He held Nvidia through 2023 and 2024, riding the very boom he predicted. But in Q3 of 2025, he didn't reduce his position, he dismantled it completely. This isn't the behavior of a trader taking profits. This is a macro investor signaling the end of a phase. Here's why. When someone managing billions wants to exit, they can't broadcast their intentions. If Druckenmiller went on CNBC and said, "Nvidia is overvalued, I'm selling everything," the stock would collapse instantly. He'd destroy his own exit. So professionals do the opposite. They sell into strength. They sell while the crowd is euphoric. They sell when retail investors are convinced the rally is just beginning. Wall Street calls this the distribution phase, when the smart money hands off shares to the latecomers. This pattern shows up in every major market top. And Druckenmiller himself has played this exact hand before. In 1999 he rode the internet boom to massive gains. But when valuations detached from reality, he exited months before the Nasdaq collapsed 78%. He didn't abandon the internet. He abandoned the bubble. Today the same dynamic is unfolding. AI is real, transformative even. Nvidia is central to that shift. But a genuine technological revolution doesn't justify infinite valuations. The question isn't whether AI matters. The question is whether Nvidia at today's prices can sustain the expectations baked into it. In early 2000, pundits said Druckenmiller was missing the new paradigm. The internet changes everything, they said. They were right about the technology and catastrophically wrong about the timing. Fast forward to now. His 2025 exit is another historical rhyme. Because when you study investors with multi-decade track records, research from the National Bureau of Economic Research shows they are right about major repositioning 70–80% of the time. You are not competing with guesswork. You are competing with someone who sees capital flows, corporate sentiment, macro trends, and political risks you will never have access to. And he's not just exiting Nvidia. He liquidated Palantir. He slashed other high-growth tech positions. This is not a company-specific view. It's a macro call. Where did the money go? Into gold miners and precious metals assets, the kind of positions billionaires accumulate when they expect inflation, currency risk, or financial stress. And he isn't the only insider running for the door. Jeff Bezos sold billions in Amazon shares in 2025. Mark Zuckerberg trimmed Meta at a record pace. Insider tracking data shows big tech selling reached the highest level since early 2000, right before the dot-com collapse. Executives are not diversifying. They are exiting while prices are still extraordinary. So what triggered this shift? It comes down to one cold, mathematical reality: the AI ROI cliff. Tech giants spend hundreds of billions on AI infrastructure, on Nvidia chips, data centers, and R&D. That spending fueled Nvidia's meteoric rise. But CFOs are now asking, where are the returns? When does this spending translate into profit? If those answers don't materialize in 2026, spending will slow, even if only by 30–40%. For a company priced for endless acceleration, a slowdown is lethal. Druckenmiller sees a gap forming, a pause between the infrastructure phase and the monetization phase. In that gap, Nvidia stock could fall 40–60% even if the technology remains world-changing. He refuses to sit through that drawdown. So he left early. Retail investors, meanwhile, continue buying at the peak of the most expensive tech market in US history. And if you're still holding AI stocks at these valuations, you are essentially betting that you understand the cycle better than a man who has survived and profited from every major bubble of the last 4 decades. You might be right, but the odds aren't in your favor. When every major insider and heavyweight fund manager is hitting the sell button, who's on the other side of that trade? You are. Your 401 is. Your index fund is. Passive vehicles and retail investors are absorbing the very shares the smart money is urgently unloading. Data from the Investment Company Institute shows that everyday Americans poured more than $300 billion into equity funds across 2024 and 2025, one of the biggest retail buying frenzies in history. Meanwhile, hedge funds and institutions have been net sellers. The wealth transfer is happening right now in broad daylight, and yet most people have no idea they're the ones financing the exit. And that sets the stage for 2026. If Druckenmiller is right about the timing, if the recession or credit crunch he's preparing for actually arrives, what happens to the people who bought at the peak? They'll be stuck holding overvalued AI stocks and tech-heavy portfolios that could plunge 40–60%. Meanwhile, the professionals who sold into the optimism will be sitting in cash, gold, and defensive assets, ready to buy those same stocks back during the panic at half the price. This is how generational wealth shifts. Not through complicated derivatives or genius-level math, but through timing. Seasoned investors sell near the top to inexperienced investors who believe the rally is endless. Then, after the crash, those same seasoned investors buy everything back from panicked sellers for pennies on the dollar. Druckenmiller's Nvidia exit isn't about one ticker symbol. It's about understanding where we are in the cycle, and refusing to be the exit liquidity for the next round of bag holders. So you need to ask yourself, which side of the trade do you want to be on when 2026 arrives? Let's break down the actual math behind what Druckenmiller sees coming. Once you understand the numbers, his exit stops looking dramatic and starts looking rational. As of late 2025, Nvidia trades at a price-to-earnings ratio roughly double its long-term average. The stock is priced for perfection, assuming relentless growth, minimal competition, and an AI boom that accelerates without interruption. Analysts defend this valuation by claiming AI has created a new paradigm where old metrics don't apply. If that sounds familiar, it should. The same arguments were used during the dot-com bubble. Here's the truth: when the paradigm premium evaporates, valuations snap back to historical norms. It's called mean reversion, and it's brutal. If Nvidia simply reverted to its median PE from the previous decade, the stock would sit roughly 50% below current levels. Think about what that means. If you own $100,000 of Nvidia today, a normal valuation reset, not a disaster, just a reset, could cut that to $50,000. Not because the company failed or the technology went away, but because the market stopped paying bubble prices for earnings. Now consider Druckenmiller's timing. Markets don't wait for bad news, they anticipate it. When he exited in Q3 2025, he wasn't reacting to today's conditions. He was positioning for mid-2026. What does he see coming? According to the Federal Reserve and the Bank for International Settlements, the US is heading directly into the corporate refinancing wall. In 2020-2021, companies borrowed massive sums at ultra-low rates, many below 3%. Much of that debt matures in 2025 and 2026. Now those same companies have to refinance at 5-7%. Imagine you're a CFO who borrowed $10 billion at 2.5%. Your interest cost was $250 million per year. When you refinance at 6%, your annual interest bill jumps to $600 million. That extra $350 million doesn't come from magic, it comes straight out of profits. Multiply that across thousands of firms and earnings are about to get crushed. And when profits fall, stock prices follow. The most richly valued names, the ones priced for perfection, fall the hardest. Druckenmiller sees that pressure building into 2026. His exit gives him a 6-month head start before those numbers hit earnings reports. By the time the media starts running stories about profit warnings, he'll be buying blue-chip assets at 40-60% discounts. That's what separates legendary investors. They don't trade the news, they trade the future. But here's the part most people aren't prepared for. This crash won't behave like the last ones. What? Because of who's left in the market. Druckenmiller is out. Other hedge fund titans are out. Corporate insiders are out. Institutions have been unloading all year. Which means when the selling begins in 2026, there will be nobody left to buy. The deep-pocketed investors who normally stabilize markets during panics won't be there. They already used their liquidity to exit in 2024-2025. That creates what traders call a liquidity vacuum, a market where sell orders flood in, but there are almost no buy orders anywhere near current prices. Instead of a controlled decline, you get violent air pockets where the market gaps down 20-30% in hours. Research from the BIS shows that during liquidity vacuums, price levels don't just slide, they disappear. Picture this. You wake up one morning in mid-2026. Nvidia is down 15% pre-market. You tell yourself it's just temporary. But when the opening bell rings, it drops to -22%. You try to sell but your order just sits. No buyers. Minutes later, it's -35%. You're watching your savings free fall with no way out. This is what happens when the smart money exits before the crash instead of during it. They remove the very liquidity that prevents financial markets from snapping. And that leads to an uncomfortable reality. If you're still holding these high-valuation AI names, you're betting against. Druckenmiller's timing. The refinancing wall. Earnings compression. The slowing of AI capex. Insider selling at 20-year highs. A thinning liquidity pool. And a macro cycle rolling over. You're also assuming you'll be faster than Wall Street when it's time to exit, something data says retail investors almost never achieve. According to Dalbar's long-term research, the average retail investor not only underperforms the market, they underperform it because of timing errors. They buy high and sell low. During crashes, they typically exit after losses exceed 30-40%. Meanwhile, the pros have already sold near the top. So let's be brutally honest about your choices right now. Option 1. Ignore the warning. Tell yourself this time is different. AI is unstoppable. Valuations don't matter. Druckenmiller is being overly cautious. Maybe you make another 10-20% before the top. But you risk losing 50% or more when the bubble snaps. Option 2. Listen to what the smart money is silently telling you. Recognize that their actions, not their words, reveal their real forecast. Reduce your exposure. Protect gains. Shift part of your portfolio into cash, treasuries, or defensive assets. You might miss a little upside, but you avoid catastrophic downside. That's what real risk management looks like. Robert Shiller's research on bubbles shows the warning signs always appear before the collapse, but most investors ignore them because prices are still rising. That's exactly where we are today. Prices up. Sentiment euphoric. Retail buying. Insiders selling. Smart money rotating to safety. Druckenmiller's Q3 filing is not subtle. It is the clearest signal he can legally send. Most people will shrug it off. Some will rationalize it away. A few will listen. The clock is ticking. The smart money has already left the room. The question is whether you'll act, or be one more casualty in the largest wealth transfer of this decade. You now know what the billionaires know. The next move is yours.